So we're going to get into tonight's topic. Like I said, I wanted to reintroduce this topic because it's been a while. It's investing basics. So tonight we're going to talk about investing basics and really bringing it back to basics. And why I like to teach this is because we're just supposed to know what investing and investing terms are. And then as you go along in life, you kind of get a little bit embarrassed by not knowing the simple terms. And before you get to being more advanced, you have to know the fundamentals of investing. So tonight is all about basics. What is investing? What are some of the most commonly used terms? And how do you choose, how do you start and how do you choose what type of investments to pick? Because there are literally thousands of different ways that you could invest your money. So let's start off by the investing rules of thumb. So I like to share this very simple. When it comes to investing, it comes in three parts, three golden rules. Number one, save a portion of what you make. This is the equivalent of saving for a rainy day or pay yourself first. Even if you have tons of debt, get into the habit of save a portion of what you make. It's so important, and we'll get into the reasons why later. Number two, invest what you save. So as you pay yourself first, as they call it, also invest what you save. But at the very least, you want your money to grow in the long term as much as inflation. And number three, at the end of it all, make sure you're being tax efficient. So it's great if you start saving and investing. As you all know, we live in Canada. The government likes to get their hands on any profits that we make. So you want to make sure that your investments are as tax efficient as they could possibly be. So what is saving? It's pretty simple, but just as a reminder, saving is literally putting money aside that you're not spending. So when you get paid, like I said, whether you're self-employed or you are a salaried employee, always get into the habit of putting money aside each pay. People always ask me, how much do I put aside? My answer to that is whatever you could commit to. If you look online, you'll see all kinds of percentages or amounts. Sometimes you'll see put aside 30%, put aside 20%, put aside 10%. Everybody's financial situation is different. If you have a lot of responsibilities and a lot of debt, you might not be able to put as much aside as somebody who doesn't have any responsibilities, makes a good income, and is cash flow positive. So when it comes to saving, make sure that you put aside an amount that you're comfortable in committing to, whether it's $50 a month or 30% of your paycheck. Choose something that you're comfortable with, and you could adjust as needed along the way. So now that we know what saving is, what is investing? The goal of investing and the reason why people invest is so that they could earn a profit. That's the whole idea of it. Now, depending on what you are investing in, whether it's in the stock market or in mutual funds or investing in your business, there are different risk levels. And this is where the fear of investing comes in, and where I meet a lot of people who hold on to their money. They know that they should invest. They know they need to start investing, but the idea of losing their hard-earned money hurts. So they don't even try. Just for those who haven't invested before, I hear this all the time. And guess what? There are so many different ways that you could invest. It's not all or nothing. And sometimes people think that investing is all or nothing. What are the most popular account types? So great, you've decided, I'm going to start putting money aside, I'm going to start investing, but where do I start? The first place that you start at is picking the type of account that you're going to put this money in. So accounts are literally visually envelopes that you put money into. And then once the money is inside those envelopes, you could decide how to invest that money. So the most popular account types here in Canada are tax-free savings accounts, or TFSAs, or registered retirement savings plans, or RRSPs. Since last year, first home savings accounts, or FHSAs, that are designed for people who are first-time home buyers. If you have children, there are registered education savings plans, or ESPs. These accounts are designed to help parents or anybody save for post-secondary education. For those who do have children, a lot of financial advisors or financial planners forget to include this in a person's financial plan. If you open an RESP for a child or for a baby, your time horizon is at least 18 years. Meaning, if you have a newborn and you open an account, in a day or 1 month, you have 18 years plus to invest this money. So it is a long-term investment. Another type of account here available here in Canada is the Registered Disability Savings Plan. So if you or someone that you're taking care of receives the disability tax credit, this is another type of account that can be used as a kind of like a savings account, but there are benefits to it when it comes to the government. And there are other types of accounts as well, but if you've kind of maximized all of these other accounts, there are also the non-registered accounts. So all those accounts I just named are registered accounts, meaning they have tax implications, special tax rules and implications. Non-registered accounts, basically the tax implications are the same. Non-registered accounts have been around for a long time, and we'll get into the taxation in a bit. So these are the most popular types of accounts or envelopes that Canadians will open to put their hard-earned money into and then decide how to invest it. So what are the different types of investments? I'm going to start off backwards by naming the bigger types of investments. The most popular investment vehicles, number one, mutual funds or segregated funds. I'm going to lump them both together. If any of you have ever stepped into a bank and you met with an advisor at the bank, they're probably offering you some type of mutual fund. All mutual funds are basically a basket of different types of investments. So for those who've attended in the past, I like to use a lot of food analogies. So think about it as a pizza, right? You could order different types of pizza. You could order pepperoni. You could order all dressed. So a mutual fund is a pizza, and then what's in the mutual fund are the ingredients on the pizza. So mutual funds come in many different forms. They could, as ingredients, be really heavy on the stock market side, meaning the mutual fund is literally invested in different companies that are listed on various stock exchanges. Or they could be a little bit more on the conservative side, meaning that they're invested in low risk type of investments like bonds and T-bills. So when I was saying before that investments aren't all or nothing, that's what I mean. Mutual funds come in many different forms depending on your risk level. So think about, again, the pizza analogy. Pepperoni pizza is pepperoni pizza no matter where you go. It's the dough, it's a tomato sauce, it's pepperoni and cheese. But depending on the restaurant you go to, there are variations of it. Some restaurants, there's very little pepperoni, others there's more. So it's the same type of idea with mutual funds. They're weighted differently depending on your risk level. Segregated funds are very similar to mutual funds in how they're set up. The difference is that segregated funds are only offered by insurance companies. Some of you might actually invest in segregated funds but don't even know it. If you have a group RRSP through work, chances are your group RRSP is under an insurance umbrella. So instead of you investing in mutual funds, you're invested in segregated funds. But the makeup is very similar. Mutual funds and segregated funds are available only through advisors. So you can't go on a self-directed platform and purchase them or invest them yourself. And like I said, they come in a variety of risks, generally speaking, low, medium, high, and I'm going to go over what those risk levels are in a second. Another common form or another type of popular type of investment are exchange traded funds. So all exchange traded funds literally mean it's a type of fund that you, Salson, or you, Natalie, or any of you can go invest in on your own through a self-directed platform. What's a self-directed platform? Most recently, like in recent years, platforms like Wealthsimple and Questrade have invested a lot of money into marketing, so they've become popular self-directed platforms, but all banks have one. So if you bank with RBC or you bank with BMO or Scotiabank, all banks have their own version of a self-directed platform where you could invest in exchange-traded funds. Again, exchange-traded funds come in many different forms. You can't really say, "Oh, I'm invested in mutual funds." Mutual funds do really well. I can't say I'm invested in exchange-traded funds. They do really well. It really boils down to what type, like what are the ingredients that are in the exchange-traded fund, because they don't all perform the same way. It's a broad category of many type of sub investments. Another type of investment that's really popular are index funds. I have a lot of people coming up to me. They're like, "Oh, I want to invest in index funds. Index funds are the best." All index funds really are, again, a type of investment that follows a stock market index. So if the stock market index does well, so do your investments. When they don't do well, if they're having like a bad week, a bad month, your investments will drop as well. That's all index funds are. Right now, these are the three major types of investments. And to make things even more confusing, index funds come in the form of mutual funds, but they could also come in the form of exchange traded funds. So a lot of these funds, like I did a video on Instagram recently that said funds, 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 everything is a fund. A lot of times they kind of overlap. And at the end of the day, what I like to teach my clients is forget the name, what's in it. Give me the meat. Tell me what's in what you're investing in. Forget about the titles, what mutual funds are, what exchange traded funds are, indexes. What are you invested in? And as an investor, you should have a general idea of what the ingredients are in the funds that you're invested in. So let's kind of dissect what those ingredients are. So there are many different types of investments or ingredients. Like when I meet a client for the first time, one of the first questions that I ask them is, when it comes to your money, when do you need it, on a scale from 1 to 5, with 1 being I need it like today. I can't lose it. I'm just parking it for a bit. Number 5 being it's for long term. It's I don't have any real goals with it. I don't need it anytime soon. Or it's for retirement. And 3 is somewhere in the middle. 3 is, like I want to make a little bit of money, but I'm not sure how things are going to go over the next couple of years. So let's park it somewhere, make a little bit of money, and maybe revisit it again in like a year or 2 or 3. Just keep an eye on it. So investing really comes on a scale from 1 to 5, but then there's a 6. The 6 is are basically any options that are extremely volatile. It's not that you can't invest in them, it just shouldn't make up the majority of your portfolio. Your portfolio is all the savings and investments that you have. What goes in a 6? 6 is something that's really popular right now that a lot of people are asking me about, is cryptocurrency and Bitcoin. Why has it come up a lot? Because Bitcoin did really well over the last, I think the last 6 weeks or so. It shot up. So all of a sudden, people who aren't investment savvy, if they, all you have to do is go on social media and see all the Bitcoiners coming out and telling you how much money they made. But it's a very volatile type of investment. I'm not saying don't do it. What I'm saying is it's a 6, meaning it really shouldn't represent more than 10, max 15% of all the savings and investments that you have. Because just as much as it's gone up, it also could crash. And actually, I don't know what it ended up being today, but I know that the price of it dipped. What else is a 6? A 6 is investing in individual stocks. So I had mentioned before that mutual funds can be made up of a lot of different companies that are listed on stock exchanges. A 6 would be me going out and buying shares of 3 different companies, right? So if I do that with all the money that I have, so let's pretend I have $30,000 to my name, and I'm interested in 3 companies, and I buy as many shares of each company that I can with this $30,000, my whole my whole return, or how well my money does, is based strictly on how those 3 companies are doing. So there's no diversity. If you pick 3 companies that are in the same sector, if the sector doesn't do well, then your money isn't going to do well. So you need to have diversity in your investments to protect you from situations where you lose all your money. So that's what the 6 is. But me, I like to focus on the 1 to 5. The 1 to 5 is you could kind of predict what's going to happen when it comes to an investment. Like I said, when I meet with clients, when do you need the money on the scale from 1 to 5? Do you need it like today? This is the money that I was given from my parents, is for the down payment of a house. I plan to buy it in 6 months. If that's your time horizon, you really don't want to risk it, especially if you need it. Okay, so basically you're trying to park your money somewhere. What's an option? High interest savings account is an option. Some of you might be familiar with those. Not my favorite thing, except when it comes to parking your money for a short period of time. High interest savings accounts should never be used for the long term. I know in the last year and a bit, the rates on high interest savings accounts have been higher than normal. They're usually not like that. And you also have to be careful now, or you always have to be careful in general, because there are a lot of these promotions and ads that you'll see online. Open up a high interest savings account with XYZ Bank and we'll offer you a 6%. But then there's that little asterisk beside it. Read the asterisk and what the disclaimer is. It is 6%, but for the next 4 months, and it's not 6% of those 4 months. The rate of 6% is the annual rate. So you have to calculate it over that 3-4 month period, however long that promotional rate is good for. And then what's the rate that you're getting after that? Usually it's something under 1% for the year. Okay, so be careful of that wording. Same thing when you see a daily interest savings account. When you read the term daily interest savings account, you're thinking, oh, I'm getting interest every day, and it's 6%. Let's say if that's what you're reading. If anything paid me 6% daily interest, sign me up. Like it's just sign me up. It doesn't exist. All that to say, it doesn't exist. So just be very careful. What's another type of one investment where I need to just park my money for a short period of time? Money market funds are an example. They are also a type of mutual fund. You could probably find them in the form of an exchange traded fund as well. Exchange traded funds, remember, or ETFs, they are available as investment funds. Either through self-directed investing, or you could also get them through an advisor. So if we jump forward to the 5 is actual investment funds. So mutual funds, ETFs, even index funds, where basically you're investing in a bunch of different companies that are publicly traded. What does that mean? So stock exchanges or stock markets, they're interchangeable as terms, are literally stores where you could purchase shares of publicly traded companies. In Canada, our major stock market where you could buy Canadian companies is the Toronto Stock Exchange, or the TSX. So this is the stock exchange, the virtual stock exchange, where you could buy shares of RBC, Rogers, Air Canada, if you wish. All those companies that you love to hate, there they are listed on the Toronto Stock Exchange. And to get on a stock exchange, it takes many, many, many years of historical history, lots of money, lots of legal fees. And why am I mentioning this? I'm mentioning this because they're not fly by night. They're not fly by night. It took a lot of work to get there. So whenever a company starts off as a private company, that let's say that I started, and eventually I want to bring it public, I put in a lot of legwork as the owner and the founder. And my goal is, when I get listed on a stock exchange, my goal is to grow. because why did I go through all of that for if I don't want to grow? So here in Canada, the biggest stock exchange is the Toronto Stock Exchange. In the US, there's the New York Stock Exchange, where it's kind of like the equivalent of the TSX here, where you could purchase shares of publicly traded companies. All the Fortune 500 companies you could get there. The other big stock exchange is the Nasdaq. So the Nasdaq is where all the big tech companies are. There's like 2,500 companies that are listed on it. So those are the three major stock exchanges or stock markets, literally grocery stores where you could purchase shares of companies. But don't think of it as purchasing shares. You're investing in shares of publicly traded companies. Now, so when you were talking about the 5, remember the scale of 1 to 5, remember I said 6 is when you buy or when you invest in individual shares of companies. The 5, what you're investing in is a group of those companies. So instead of buying Canadian Tire, Visa, I don't know, American Express as an example, instead of falling into the 6 and investing in shares of these 3 individual companies, what you could do is, as a 5, you could look into investment funds, whether they come in the form of mutual funds, segregated funds, or ETFs. You could invest in a basket of companies and therefore diversifying your portfolio without having to go out and invest in shares of all these companies. So like I said, mutual funds, segregated funds, and ETFs, they come in many different forms. They, as an investor, you might say to yourself, I like Canada. Canada's pretty safe. I prefer to invest in an investment fund that's more Canadian geared. Other people like to be riskier, and they might go to the US and invest in US funds, whether it's a mutual fund or an ETF that's more US geared. You might decide as well that, you know what, I like a little bit of both. So you might go with, if you take a look at all of your investments, you might go with half of your investments in the US, half in Canada. There's so many ways that you could structure your portfolio. It just depends on your comfort level as well as what your time horizon is. But you have to invest at some point, because otherwise, when you reach retirement and you look at your RRSP, for example, all the money that you're going to see in your account is money that you've put aside, and you're not going to see any growth. And the whole idea, how people say you have to let your money work for you. Investing your money properly and wisely in funds or in investments that have a history, have a solid history, that's how you have your money grow for you. If you're talking about a 3, so remember I said on a scale from 1 to 5, if you're a 3, you don't you want your money to grow, but you don't want to take too much risk. Maybe there are things changing in your life and you just want to see how things go. So a 3 is an equivalent to what's known as like a balanced fund. So a balanced fund is half conservative investments, half invested in the markets, or a little bit of variation of both. So it might not necessarily be 50-50. It might be 40% of the fund is invested conservatively. So in money market funds, something that I mentioned before, or bonds, as an example. And then the rest, the 60%, might be invested in equities. When it comes to returns, balanced funds in general, they generate an average annual return of somewhere around the 4-ish% annually, year over year. Again, this is the average return over the long term. If you're talking about the 5s, so investment funds that are predominantly invested in the stock market, whether it's Canada or the US, funds that are more Canadian based, like if you look at it, the pie is heavy towards Canada. The average annual return over time is usually around the 7-ish%, 7.5, around there. When it comes to US could go anywhere from 10-11% right up until 17-18%. Why such a difference in returns? It depends on how much of that specific fund is invested in tech and emerging markets. So not the Fortune 500 companies. When it comes to how do I choose my investments, or how do I, there's so many of them, which one do I choose? Again, it boils down to forget the titles, forget the names. What's your comfort level? When do you need this money? And then from there, with the kind of the tips that I gave to you, you could kind of choose. There are literally, like I said, thousands of different types of investments. Don't go crazy over nitpicking. It's really, a U.S. equity fund is a U.S. equity fund. A Canadian equity fund is a Canadian equity fund. Index funds mimic an existing index. So an index basically tracks the performance of a group of stocks. Here in Canada, we have the Toronto Stock Exchange, but then we also have the TSX S&P Composite Index, which tracks the performance of most of the companies on the Toronto Stock Exchange. So whether you're invested in like a Canadian fund or you're invested in an index fund that tracks the TSX, the performance is going to be very similar, because essentially they're not the same, but they perform the same way. So that's why I say we spend a lot of time trying to nitpick every little detail. A lot of these funds, a lot of these investments overlap. It boils down to, what is this fund? What is it invested in? And when you take a look at, let's say, the fund fact, you could kind of see what it's in. You should be able to see what it's invested in. If it's mainly invested in Canada, is it more US? Is it more global? Do I understand what this is? Do I know? Can I predict the outcome? None of these investments are guaranteed. The ones that I named, but you could logically, if you have a bit of a time horizon before you have to start withdrawing money, you could see how it's performed in the past. And like I said, if you're investing in the markets, and especially in like baskets of companies, none of these owners, none of them have that plan to go bankrupt and get delisted. It happens. It does happen. There are companies who do become public, and then they're not able to sustain it anymore. But if, let's say, all of your money was invested in that one company, then I'd be scared. That's where the I lost all my money comes from. But if you're invested in an investment fund that's invested in 100 different companies, even if one company doesn't do well, or one company, completely like gets delisted and is no longer allowed to be in the stock exchange anymore, it's one company out of 100. And chances are, even if it was one company, it was probably worth 0.0001% of the entire fund. Because if you have 100 companies, it doesn't mean they're all weighted the same in the investment fund. So what are some of the principles of investing? Number one, set clear goals. So again, when do you need this money? Like, forget financial jargon and financial talk. When do you need this money? Some people don't have any goals. Some people, they just want to put money aside because that's what they tell you to do. So you don't have any real goals. If you don't have any specific goals, put retirement as one of your goals, and then work backwards from that, because I don't care what anybody says. All of us want to retire at some point, even those who are workaholics and say that they're going to work until they're 80. No, the reality is all of us do want to retire at some point. So if you don't have any set goals, maybe you don't want to buy a house, maybe you don't want to vacation, 4 times a year, maybe you don't have any big goals, set retirement as your goal and work backwards from that. Number 2, understand the risk of your investments. What are you invested in? You don't have to give me the percentages of, you don't have to tell me how much it did and how well it did in 2019 versus 2020. But if I ask you over coffee, hey, how are your investments doing? What are you invested in? You should be able to answer that. And if you don't, that's an issue. Even if you use one of these platforms like Wealthsimple. I've seen it with clients, like clients who started with self-directed investing and then they became my clients. They think they know what they're invested in, but they don't, because they just answer all the questions in the algorithm, and then Wealthsimple will shoot out a portfolio and they have no idea what they're invested in. So you should have, you should understand what you're invested in to know what type of risk you're taking. Number 3, diversification. Again, I could go out, take all my money and invest it in just two companies. But then my whole return is based on the performance of those two companies. You want diversification. That way, your all of your money doesn't, completely drop at once or completely do well, right? Your money should never completely go up or completely go down. There should be a balance somewhere. Number four, invest for the long term. Everyone asks me at some point, what's the best investment to get the highest return but the lowest risk? It doesn't work. Okay, investing is for the medium to long term. What I would love is for every woman that I meet to kind of shift their mindset and start investing and basing their goals or what they do on their investment returns. So I could probably do, I've never done this, but I could probably do a whole session on, instead of, how we put money aside to go on vacation, how about you start investing your money and then when your returns do well, you take your returns and that's what you go on vacation with. But it requires a little bit of sacrifice in the beginning and maybe not taking a vacation a year, depending on how markets are doing. But investing is for the long term. It's not timing the market, it is the time in the market. The longer you stay invested, the depending on what you're invested in, the higher the chances of you getting a higher return. Plus, that's where compound interest comes into play. Interest, there's simple interest, which is, your investment makes 7% annual return, which is literally 7% of whatever money you put in. But then there's compound interest, which is the interest on top of the interest. That's what you want, but you have to. It's not day to day. You have to stay invested for a long time. And number five, start early. If you haven't started yet, start tomorrow. It's, I love it when I meet people who are my age. I'm 43 and they're like 43, 45, and they tell me, oh, it's too late to start putting money away for retirement. Unless you plan on retiring at 50, it's not too late. The only time it's too late is when it's actually too late, which you don't want to get into that situation. And like I said in the beginning, start early, start putting money aside, start investing, even if you have debt. And why? I know people in my field have their own ideas about this. Why is it important to do that? Because if you work on paying off your debt first and not putting money aside, guess what happens when an emergency comes? You're gonna put it on a credit card. You're gonna put it on a line of credit. You won't have this cushion built up. So you're going to fall back into debt anyway. So yes, again, if you have debt, it might take you a little bit longer to pay off your debt, but you want to make sure you have a cushion in case something happens, because otherwise, once again, when an emergency arises, you'll just put it on a credit card, which kind of defeats the purpose. So those are, I hope I covered everything. I tried to do it in 15 minutes, which I clearly didn't. Does anybody have any questions?